Welcome to What to Expect When You're Expecting to Buy a Home. This buyer masterclass is one that we've hosted twice a year for the past 13 years for our community. So it's something that we really enjoy hosting so that people can, kind of help figure out how to navigate this market. I think it can be a very daunting experience to even think about purchasing a property. So this is a helpful way to gain the tools that you'll need as you embark on your home purchasing journey. So the goal is to help demystify what's going on in the housing market and give you a forum in order to ask any questions that you might have. So it is meant to be very casual and conversational. So by any means, if at any point you have a question, we invite you to ask those questions. No judgment here. We won't, there's no dumb questions. So and we also have Andy Christenot, who will introduce in a little bit, who is on Zoom.
Hi, everybody.
Yeah, Andy is our lender partner who's going to be giving us quite a bit of information about the housing market and whatnot today too. All right, and meet the team. So my name is Tiffany Chin. If we haven't met before, nice to meet you. I am the founder of the Tiffany Chin Group based out of this Keller Williams Larchmont office. I've been here for 13 years now. So I am originally from Fremont in Northern California, moved to Los Angeles to attend UCLA and never left. This has become home. My sisters live here. We are very much ingrained in the community. And, we've had the good fortune and honor of working with this community and our beloved client community for the past 13 years, which has been a whole lot of fun. It's very special to be a part of our clients' lives in that respect. And what we do a little differently is we really enjoy seeing our clients beyond just, a purchase or a sale. So we have client events throughout the year. We have 4 or 5 throughout the year. We have a Women's Day event where we invite all our women to celebrate International Women's Day with us. It's a fun time. We'll leave it at that. What else do I need to tell you? And this is our team. So Rachel Biggio is our buyer specialist. So she comes from a TV production background, which many of you may know is a very go, go, go type of industry. And so she brings that same spirit to our team and our clients, which can be very helpful in the buyer experience because so many things are very time sensitive. So Rachel has been with us for the past 5 years. She started off as my assistant and within a year quickly rose the ranks and became a buyer specialist. And it's been a fun journey. Yeah, our clients really enjoy that. She takes a very friendly approach and very protective approach with our clients, which is important when you're purchasing a property. She will tell you more about herself later. Cameron Blake is our director of operations. She is the newest addition to our team, and this is her first event. The first of many, I'm sure. And, it's been really fun to see the energy that she's brought to the team and our community. And we are very excited for, how you'll brighten up each day and our clients' lives as well. Andy Christenot is the branch manager of Movement Mortgage. Like I mentioned before, she is one of our lender partners. And she comes with such a wealth of experience. So she's been hosting these workshops with us for, I want to say, at least the past 10 years. And the reason we love hosting them with her is she takes on this very holistic overview of the purchasing process in the mortgage industry and helps you understand the economics behind it all. So she has been in the industry for over 25 years, and she hates it when I mention. And that's special because then she can lend some good insight into the different real estate and mortgage cycles and how this one compares to previous ones. Right? And with that said, I will turn it over to Cameron, who will give you the lowdown of what's to come today.
Perfect. So today we are going to cover the 2024 housing market update, impact of the NAR settlement, how the home buying process works, how to get pre-approved for a loan. We'll have a little break, and then when is the right time to buy, the benefits of owning a home, how to write a winning offer, what to watch out for, and then we'll have a little Q&A session at the end.
And during the intermission, that's another chance for you to come up, get more food, refresh your drinks, feed your meter if anyone's parked at a meter. They do patrol here, so please keep an eye out for that. And there are restrooms just straight down the hall towards that red frame door that you see. You'll hang a right, and there are a number of restrooms down that hall. All right, the 2024 housing market update brought to you by Andy Christenot.
Thank you so much for having me. Like Tiffany mentioned, I've been lucky enough to take part in these homebuyer workshops for, gosh, about 10 years. I've been in residential mortgage lending for, I think this is my 26th year. So definitely seen some cycles. And as Tiffany also mentioned, my approach really is to just educate people and to be a resource through the process, whether I'm in doing somebody's loan or not. It's important to make sure people have all the information, they know what's going on, and really know the basics of the economics behind these cycles and behind mortgage rates. There's a lot of misinformation out there. So I'm sure you've all heard, marry the home and date the rate. People are waiting. We've seen in the last couple of years, interest rates, mortgage interest rates specifically have gone up. They've more than doubled than they were in the COVID years. And there's a number of reasons for that. In addition to that, separate from mortgage rates is what we call the Fed fund rate. So every time you hear news that the Fed is meeting and they're talking about discussing lowering interest rates, et cetera, that doesn't directly relate to mortgage rates. The Fed fund rate is related to short-term credit, things like credit cards, student loans, car loans, et cetera, home equity lines of credit. But where we are intertwined with the Fed fund rate is obviously the basics of economics. So just some quick statistics here. Roughly almost 40% of buyers in a study and a survey done in the last 12 months, almost 40% are saying that they're waiting for rates to come down to buy. Understandably, if we're talking about higher interest rates, that affects affordability, et cetera. What the kicker is that waiting for interest rates to come down then throws in an additional factor that, sure, it's great in theory to get a lower rate, but once rates do come down, you have a slew of buyers who have been waiting, this almost 40% of buyers that have been waiting on the sidelines, waiting for rates to come down. All of a sudden, that adds to the competition, right? So higher interest rates from a mortgage perspective are actually a buyer's best friend. If a buyer can assume the payments and take on sort of the initial payment shock and understand that things are temporary, it works to the buyer's advantage to get in at higher rates when there's less people that are bidding on the same properties, et cetera. For every 1% drop in mortgage rates, they're estimating roughly an additional 5 million more buyers in the market. As rates come down, that also presents a bigger eligibility for buyers who maybe don't qualify for higher interest rates. So keep that in mind. And when we're talking about today's market as well, and looking at higher interest rates and getting in and buying at a higher interest rate environment, we're talking about also supply and demand. With tight inventory, that increases competition. As interest rates come down and competition increases, that doesn't necessarily mean there's going to be more inventory. So if we're talking a tight inventory market and more buyers, that then drives up the price. In a short-term basis or comparison, if you're talking about paying, we had a decent week this week in interest rates. If we're talking about paying a 6.5% interest rate or 6.625 on an interest rate now for, say, $1 million property, a year from now, that $1 million property with the added buyers that come into the market when rates do drop, you would have missed out on potentially the 6, 10, 15% equity appreciation when rates do come down. So it poses an upward pricing pressure. When interest rates come down, it means that values go up. And in this market too, there's a big misconception. We've seen some price drops, but where we're seeing price drops in property is because they're overpriced to begin with. And so appreciation continues, just on a statistical basis and on a national basis, and especially in a competitive market like Los Angeles. Appreciation continues, and as rates come down, that appreciation rate will go up at a faster rate than it has been in the last 24 months. And just to give you a little context of inventory and market conditions, existing home sales in June of this year roughly declined 5.4% month over month to an annualized pace of 3.9 million units. Year over year, it's down by about 5.4%. And that's because you have you have sellers that are not selling, and because they're sitting on lower interest rates and so forth. To the point about appreciation, the median home price nationally went up 2.3% month over month, and it's up 4.1% year over year. And again, this is national numbers. So if we look at competitive and high price point area like Los Angeles, that median home price is higher than that. And the appreciation year over year and month over month is higher than that. Inventory on a historical perspective is at an all-time low, which also means that days on market is less. Again, we're talking competition, right? It's a supply and demand issue. There's little supply and there is a huge demand for property. So days on market is averaging, this is based on June's numbers, at roughly 22 days on the market. And that's decreased pretty substantially. Even so, May, we had an average of 24 days on the market. April was 26, March was 33 days. So as you can see, the summer months have heated up. People are getting off the sidelines. And recently in the last couple of days, we saw a pretty significant rate drop, which then sparks more interest. Then you've got some additional statistics about sales over list price. This means that they're selling for more than what they're listed for. 29% from 30%. This is month over month. And then 33% sold over list last year. First-time home buyers is about 29% versus 27% of last year. Cash buyers is about 28% of the market, which is also a big kicker too. If you're trying to get into the market and you have financing and you need to have a loan to purchase, almost 30% of the competition is cash. Investors make up roughly about 16% of buyers and folks that are in the market for properties. And this is, again, based on June of 2024 numbers. So insanely competitive. And this slide just gives a graphic of the cost of waiting. And this goes back to the point of think of things in a short-term basis, right? So I bought my house in Studio City, I bought 12 years ago or 13 years ago. And rates were much different then. I refinanced twice, I think, in the first 18 months or 24 months because interest rates had come down. If you wait for rates to come down to purchase, you're losing out on all that appreciation. Like I said, once you get the additional buyers into the market when rates do come down, you're missing out on that appreciation gain. And then once rates do come down, once you're in the property, you can refinance and lower your monthly outgo. So as rates come down, appreciation goes up. Rates eventually come down, which presents an opportunity to refinance. The longer someone waits, the more expensive the same property gets. In this scenario, we're looking at a property at 1.5 purchase price with 20% down. So you're financing 1.2 million, roughly at a rate of 6.5%. If you're waiting 6 months, you're losing out roughly, and these are pretty conservative historical averages for LA County. waiting 6 months, you're at 4.6% in appreciation gain. And estimates are looking at roughly around 6% for interest rates, by the 6 month mark. Of course, nobody has a guaranteed crystal ball, but this is what we're speculating. This is what we're estimating. If you wait 1 year, again, the conservative average is roughly an appreciation gain of 5.47.
All those green numbers up there.
What's that?
I'm just chiming in that we're looking at the green numbers up there on the table. It's fine. Nothing.
Okay.
Yeah.
Yeah, so the little green numbers under the second line roughly are the historical averages of appreciation. And then if we're talking 1 year down the road, if interest rates are at 5.5%, again, you refinance. So a year prior, you go in at 6.5%, and a year later, you're at 5.5%. The difference in monthly payment is pretty substantial. Waiting 2 years, and again, these are really conservative. 2 years, 10.5% in appreciation. As rates come down and the competition goes up, these appreciation numbers will be much higher than this, right? So if you get into a property today at 1.5 million, 6 months down the road, if rates are 0.5% lower, that same $1.5 million property could go for 1.6 million. It could go for 1.65 million. We're already seeing it again where properties are going into multiple offers well over the list price. So it's cheaper in the long term to pay the little bit higher in the interest rate and higher payment to gain that appreciation and then eventually refinance down the road. So down here at the bottom, you have the cost of waiting analysis. And in these scenarios of 6 months, 1 year, 2 years, 3 years, at year 3, in this very conservative look, you would have missed out on $280,000 in potential appreciation gain if you had waited for the rates to come down. And this is just another graph, just emphasizing the previous illustration. So the appreciation loss after 6 months is roughly $68,794. Then you've got, and the total cost is related to down payment. If you were to buy the same property in 6 months, 1 year, 2 years, 3 years, the total cost is what you would pay if you wait to purchase that. And then you've got, in the taller columns, you've got the appreciation loss. The amortization loss is the amount that you would have paid down that loan in that amount of time. So by year 2, in the scenario of a $1.5 million purchase price and a loan of 1.2, in 2 years, you would have paid it down almost $30,000 and gained almost $160,000 in appreciation based on very conservative numbers. And by year 3, you're looking at a conservative estimate of $237,000 in appreciation loss, and you would have paid down your loan almost $43,000. That's a big loss compared to paying maybe a couple $100 extra per month in a very short term. Say you're paying an extra $200 a month over the next 12 months before you refi. That $200 a month, let's just say, or $2,400 is way less than the potential loss by waiting.
Are you going to talk about the refi process? Because I've heard some people say it's easy, some people say it's a pain.
Yeah, so the refinance process, of course, you have to qualify to refinance again. So, if you purchase now and your circumstances change by the time rates come down and you're ready to refinance, I mean, certainly there could be variations and so forth. There's also a ton of different loan options out there. So if your circumstances do change, there are potential options to refinance you. From a process perspective, a refinance should be pretty darn painless. It's going to require some updated paperwork and things like that. Closing costs are much less. Movement's offering a deal where if you close your purchase loan with us and you refinance with us, by the end of next year, we'll waive our lender fees on the refinance. So the cost is lower on a refinance. The process should be pretty straightforward and pretty painless. I mean, I can close a refinance in 2.5 weeks. It shouldn't be difficult. If it is painful, then I would say that that lends itself to the loan officer or whoever is processing that refi.
Well, and I can kind of speak to this. So when I first started working with Tiffany and I got my license, I owned a condo and we had a wealth of credit card bills that I needed to pay off. And I had only known Andy a couple months, I think. And we were talking and she was like, you can refinance that condo. And so I went through the process with her. It was so easy because I'd done it once through another big bank and it was not a good time. So she made it super, super easy to do. So I can speak from experience. She also did my home loan a couple years later. My first time with Andy was a refi.
I think the big takeaway from the previous slides is that, you know, if you can purchase while people are not in the game yet, like really in the game, it's better too, because then you're purchasing at a lower price before everyone floods the market in order to take advantage of the lower interest rates, right? So in January of 2023, that's when rates started to spike and people were waiting on the sidelines. That's when I decided to upgrade and purchase my single family home. Even though, you know, it was like a weird time to do that, it made sense to me because there were fewer people who were in the game. So people were much more flighty at that point. I actually seized on an opportunity where a buyer backed out of the purchase because they got nervous. So there's just much more opportunity when there are fewer people who are competing with you. So, and the great thing is that, you know, you can purchase at a lower price and then, you know, you're not locked into an interest rate that is higher at this point. And then you can refinance down the line. And that was always my intention, refinance down the line.
Okay, and on the flip side, I had to move during the pandemic. We had to sell our condo and get out of there. And I was competing at the time, my rate was like, I don't know, 3.2, it was very low. There were 34 offers on my house because everybody was trying to buy. So we had to go significantly over the list price, but circumstances we had to move. So
yeah, sometimes you can't time it. That's how life goes. But if you have a little more flexibility, you have that luxury of kind of figuring out, okay, if people are hesitant right now, maybe it makes sense to get in while we can, because that purchase price stays with you for the entirety of how long you own the property, but the rate doesn't, right? You're not locked into that. All right, so now let's talk about the NAR settlement. Is everyone familiar with the NAR settlement? Okay, we'll give a very quick overview. So there was a lawsuit that originated in Missouri where sellers felt like they were not properly disclosed that the commission to the buyer's agent was negotiable. They felt like they had to offer compensation to the buyer's broker. So out of that lawsuit, the National Association of Realtors settled just to, you know, clean the slate and start over. So we want to kind of go over, you know, what the takeaways are from that and how that impacts you as purchasers. Okay, so the two main takeaways from the NAR settlement are that all buyers will be required to sign a buyer representation agreement prior to any private showings. So if you choose to work with an agent, you will be signing a buyer representation agreement. And in that agreement, you'll be negotiating with your broker as to what their fee is, what their fee to represent you with. We'll go into how that plays out in the next slide. And then the second impact is that sellers will no longer be able to offer buyer's agents compensation on the MLS. So this is a behind the scenes look at it all, but the MLS is where realtors all input the data for their listings. So on that MLS, there was a section where agents could see how much the seller's agent was going to offer as a percentage of the purchase price to the agent who brought the buyer, who represented the buyer. So no longer will that be allowed. All right, so how will the buyer's agent get paid? So this is what affects you. So this is the main thing that these are the main things that you'll need to know. So the first and probably we anticipate the most popular way that this will unfold is that the buyer will request through the purchase agreement contract. So when you submit an offer, that the seller pay for the fee agreed to in their buyer representation agreement. So in the representation agreement, it states that this is the fee that you'll be paying your agent. But anyone else who pays a fee, it'll be credited towards that obligation. So how that plays out is, you would work with your buyer's agent to offer as a term of your offer what that fee will be that you're asking that the seller actually pay on your behalf. That's how.
That would, sorry to interrupt, but that would offset for the buyer some of that fee.
Exactly,
Okay.
exactly. So it'll just be one of the terms of your offer. So it essentially, becomes the same thing. Another way is that the seller may agree to pay concessions to the buyer. So this is a credit towards your closing costs, towards what you would be liable for the purchase. Which then you can use to pay the buyer's agent. So if they credit you a certain dollar amount, then you can use that credit to then pay your buyer's agent, which offsets what you've agreed to with your buyer's agent. And the third way is the buyers pay their agent directly at closing. This is a possibility that you could offer in that you, instead of building it into the seller's obligation, you end up just paying the agent directly. But the way that we've been talking about it in the industry is that this first option is probably going to be the most common way that people will go about it. Any questions?
So.
Yeah.
How is this different from before? Before it was mostly just number one.
Mm-hmm.
So now this is like this clear number that you agree upon working it.
Yeah,
And number one is like what you go for, but it might not be buyer.
exactly.
So the thing to keep in mind here is that, we're gonna try to find out ahead of time, like, is the seller willing to pay? That's a conversation that I'll be having with these agents. And then I will relay that to our clients. So before we even go under contract, if you'd be responsible. If you would be responsible and you don't want to be, you don't have to write on that property. We can then try, somewhere else.
You're never going to
So,
be stuck.
Yeah, you will always know.
Yeah.
And given the option, what do you want to do?
And that's the idea that was their whole goal with the settlement, that everyone is fully aware of what the buyer's agent is being paid. So this just now clearly states what that is in the documentation so that it's not a mystery to you as a buyer, and that the seller now clearly sees in their, offer, in each offer, what they may be paying to the buyer's agent.
Presumably, it's like a pretty common percentage number, right? That's more or less common for transactions.
Yeah.
Okay.
I know it's confusing because it shouldn't be confusing. I think that's how it goes back.
I mean,
Exactly.
Right.
Yeah,
Yeah.
exactly. And it's always, most people had it baked in already. The seller most commonly paid the buyer's agent. So we assume that it'll probably be the same, especially in a market like Los Angeles, where it's a little unreasonable to expect that a buyer has this huge sum of money that they can pay their agent out of pocket after purchasing a large property too, after making such a large purchase. So
What is concessions?
it's basically a credit towards the buyer's closing costs. So when you're purchasing a property, you have the down payment that you're bringing to closing in order to fulfill that portion of the purchase. And there are also costs associated with purchasing. So there are title fees, escrow fees. Rachel will go into this a little bit more. So there are extra fees on top of that down payment that you'd be bringing to the table. So now that would have been cash that you'd be bringing in, but any concessions would be a credit against that cost. So then it deducts, what you would be bringing to the table. It offsets.
And are those extra fees included in the overall listing price, or
No.
is that like the hidden fees?
It's not a hidden fee. You'll have you'll have an estimate, so you'll see what the
Oh.
breakdown is. Yeah. So there are title fees, escrow fees. There are a couple of different parties that are involved
Okay.
in the purchase process. Yeah. And there are, property taxes that you will be prorated for, insurance and all of that.
Okay.
the cost of purchasing. We'll go over that, or Rachel will go over it. All right, Rachel, you're up.
Well, I guess you're gonna need you'll need Okay, so how does the home buying process work? Okay, the first thing you're gonna do is you're gonna pick a real estate agent that you want to work with. The next thing that you're gonna do is get pre-approved for a loan. This is extremely important that you get pre-approved before you start looking at properties, before you visit open houses, before you do anything. We want to make sure.
Not on camera, right?
Oh.
Yeah, there you go.
Okay. We want to make sure that we know where you're comfortable in terms of your budget. We want to make sure that you can afford the monthly payments. Because I guarantee if you go to a property and we find out you can't afford it, you're going to be crushed and no other property is going to live up to that. So it's really important that we kind of get all the financials figured out before we even start the process. It's also not uncommon in our competitive market that if we're at showings on a Saturday or a Sunday, offers could be due on Monday. And with that offer, you have to provide a pre-approval letter. So, that pre-approval can take a day or two, depending on, how complicated your finances are. So we just want to get that all figured out before we even do anything. The next step is to meet with your agent for a buyer consultation. Well, this is how we work. So in the consultation, we're going to do a deep dive of all of your wants and needs for your future home. We're going to find out, your timeframes, what's important to you. Anyone that is going to be living in the property, we want, to talk with them so that we understand, everything that you're looking for. At the end of that consultation is when we will ask you to sign that buyer representation agreement that Tiffany was mentioning. So every buyer is going to be required to sign one if you want to work with an agent. Once that agreement is signed, then we will set up a custom MLS portal for you. So like Tiffany was saying, the MLS is where agents input all the information about the property. And then that's what you see on Realtor.com, Zillow, Redfin. So within that portal, we're going to set some parameters based on our conversation. And then that portal is going to send you a daily email with all the properties that are available within those parameters that we have set. So I get a copy of those emails for all of our clients. So every morning I'm looking through to see, okay, what's new on the market, what could be a good fit. And then we kind of talk about it and say what is worth going to take a look at, what is not worth taking a look at. So then we'll go look at properties. This is the fun part. I love going on showings. First of all, I like to get to know our clients. Buying a home can be very stressful, so it's helpful for us to spend a lot of time together. I also want to see, how you guys are in a home, how if you're buying with a spouse, a partner, or whoever it might be, how you guys interact with each other. It just helps us get to know you. I also want to have my eyes on the property if it's one that you really are interested in. Because when we're at showings, I'm looking for red flags that our clients may not be paying attention to. I'm looking for things like water stains on the ceiling or places where we typically find mold. One property clients were interested in, I walked in and I was like, it's a little slanted. And they couldn't tell that. So this just helps that if you do want to move forward with the property, we kind of know a lot about it. Yeah.
Is there a slide that you guys have where you talk about do's and don'ts for writing the offer letters? Okay.
We have a tips and
Okay.
tricks. The other part of why I like to go on showings is that if you're interested in a property and the listing agent is there, that's a really good time for me to kind of pick their brain and get to know them. So then that way, when you're writing an offer, they already know us. They can tell their seller, oh yes, I met them. They seem to know what they're doing. They ask the right questions. It can really make a difference if I can connect with that agent. So after we've gone to see some properties, if there is one, let's say there's one that you're interested in. So what do we do? If you want to write an offer, the first thing I'm going to do is what I call doing my homework. I want to try to find out everything I possibly can about this property. First thing I'm going to do is look at recent sales in the area to see how did the agent price this property, because there's different strategies. Some properties are priced low, which drives in the buyers, which will drive up your price. Some properties are overpriced. And then some are kind of priced right. So I want to try to see like, okay, what else sold in the area? What is similar so that we can kind of gauge like, oh yeah, this is severely underpriced. We're going to need to come way up. And maybe that goes out of your budget. Or maybe it's no, we have the room, let's kind of do that. So we'll look, those are called comps. We're going to look at the comps. So that's the first thing I'm going to do. I also want to look to see if what you see online in terms of like the bedroom and bathroom count match what's on title. Because if the title is different, say title says there's only 2 bedrooms, but in reality there's 4, there could be some unpermitted spaces there. So we just want to know if that's the case. I'll look up permits to see what can I find online, what has been permitted. This kind of gives us an idea like, oh, the roof was permitted 2 years ago. Great, it's a new roof. And that can impact, your offer. So just try to find out as much as we possibly can. If the agent is not there, I will also call the agent, try to find out, anything about what's motivating the seller, how many offers do they have? Is there an expectation on price? Because some sellers are saying, I only want a certain price. So we gather all this information and then I give it to you. I will tell you what I think the property, might go for. I am not a wizard. I don't have a crystal ball. I cannot guarantee anything, but I can just tell you based on my experience and what I know. But it will be up to you to decide how you want to proceed because at the end of the day, this is your home. It's not mine. I'm not paying the bills. So you have to feel comfortable with what you are offering.
Essentially our approach is we gather as much information as we can and present it to you, present our opinion, and then you decide. Like it's your purchase, so it matters what you think. But Rachel is not afraid to tell you if it's a truly horrible home and that it's not good. It's not a good investment. So, we see a lot of homes. We've seen probably thousands of homes by now. So, we know what sells and what doesn't. We know what buyers look out for, and we need to also know what the sellability, the resale ability of this property will be after you're ready to unload it. So,
And geographically, you're working everywhere.
Yes. So our business, I would say, is what 90% referral,
like 90% repeat and referral.
Repeat and referral. So it's really not like neighborhood focused. It's where our people are that we go everywhere. So what's
Not everywhere.
well, we go a lot of places. Let's put it that way. I live in the Valley, so I do cover all of the Valley. We've gone as far. I will go down to Long Beach if that's the case. It just
much the main
area.
Yeah.
And if for some reason you do decide that you can't afford this area, you want to go to like Orange County or you want to go up to Ventura, we have agent partners in all of those cities that we can refer you to. So you're going to, that we trust, because you're going to hear me say a lot. We're very protective of our clients because our clients become our friends. So we treat our clients as if they're our friends, our family. We want to make sure you are taken care of.
If you're in a drastically neighborhood that you're looking in, that's not our area of expertise. So it'll serve you better to be with one of our lender partners. Yeah, I'll match you up with them.
Okay, so let's say you've decided to write an offer on a property. We submit
Agent partners. Sorry.
You decide to write an offer on a property. We submit the offer. One of three things can happen. A seller can either just accept your offer, which is awesome. They can flat out reject your offer, which typically we don't submit lowball insulting offers because it's just not going to work. More than likely, we will get a counter offer. Once we have that counter offer, I call the agent again and say, okay, where did we come in? Can you share anything about the other offers that you were given? So at this point, I've now spoken to the agent probably 2 or 3 times. They started to get to know me, and they more often than not will tell me more than if I've just never communicated with them and I just blindly email in offers. So it's all about kind of building that relationship so I can just get more out of them. And it doesn't always work, I should preface that, but we have good success. So once we submit the counter offer, if the seller decides to accept your offer, then we will go ahead and open escrow. Okay. Does anybody know what escrow is? Since you can't answer. Okay, escrow is a neutral third party that the buyer and seller hired together. And they're the ones that are making sure everyone is abiding by that contract that we just negotiated. It is typical in our market for the seller to choose the escrow company, but they are neutral party. So once escrow is opened, the first thing that's going to happen is within 3 business days, you will have to wire in your earnest money deposit. Your earnest money deposit is 3% of the purchase price. Now, this is part of your down payment. It is not in addition to, but it's essentially your way of telling the seller, like, you have some skin in the game now. So if we breach our contract, that deposit is now kind of up for grabs for the seller to take. We will not let that happen. So this is just, you know, like I said, it's your way of telling the seller you are serious.
It's your skin in the game.
Yes. Yeah. So within the contract, there are 3 big contingencies that we will have negotiated during that negotiations process. These contingencies are your protections. They are your way out of a contract while still getting your deposit back, as long as we are within our timeframes that we set during the negotiation stage. The big 3 are your inspection contingency, your appraisal contingency, and your loan contingency. You will hear us talk about, you know, in a competitive offer situation, waiving contingency. We will talk about that later. For the sake of this, we're going to pretend all of your contingencies are in place and that you are, you have these big protections. These all have timeframes that are associated with them, and those timeframes run concurrently. So they all start as soon as we open escrow. The first contingency, which is typically our shortest contingency, is the inspection contingency. And depending on the type of property, that's anywhere between like 5 to 10 days. During that time, we will get inspectors out to the property so we can try to learn as much as we can. If it's a single family home, we're going to do a general inspection where the inspector will go all the way under the house through the roof and check out everything. We will have a sewer line inspection because you got to get your sewer lines checked. It's really not glamorous, but it's very important because that can be very costly and gross. We'll do a termite inspection. Termites are very common in Southern California, I think all of California. It's what we deal with here. So it's nothing to be scared of. They're very normal. I would say 9 times out of 10 houses have them. We will handle it. And then if there's a fireplace, we'll do a chimney inspection and like a pool inspection, if it has a pool. Yeah.
So if there is like mold or termites or a major issue, is it the seller that handles all that? The expenses and the repair fees and everything?
Okay, so let's say we do, that's a great question. So we do our inspections. Backtracking real quickly, if you're buying a condo, a lot of that is covered under the HOA. So we typically just do a general inspection plus chimney if there's a fireplace. But so let's say we do our inspections and we find problems. Every house has problems. New construction has problems. And a lot of times sellers don't know the problems that their own house has because they don't go in the crawl space. They don't go, you know, if there's a pipe that's cracked under the house and you can't tell from inside the house, how would you know? So a lot of sellers can get inspections are a very nerve-wracking time because we're going to pick apart the house. So once we do our inspections, the inspectors then give us written reports of their findings. We will sit down together and kind of look at the big health and safety issues. We want to make sure you are getting a home that is safe, that there's no health issues that can't be taken care of, you know, and that anything like major that's broken, essentially, that is what we are focusing on. If you're buying a used home where someone has lived, it is expected that there's going to be scratches in the floor and stains in the carpet. Those are all cosmetic. We just want to focus on health and safety. So together, we will kind of go through those reports and pull out what we think we want to ask the seller to either repair or give a credit. The credit is essentially cash that goes towards your closing costs. Depending on the type of repair, we typically prefer to get you guys a credit. And then that way, after closing, we can, you can hire the repair people that you like to make those repairs versus if we ask the seller to make the repair, we're at the mercy of whoever they choose. So
Whoever you like and trust.
yeah, so
That's
that's,
a good way to process, right? If the seller was having to
It can,
things?
it can.
Depending on what the repairs are.
Yeah, there are some repairs that we won't close until those are fixed because they may have like a bit of an unknown. Mold is one of them, because mold is an unknown. So we can't damage a property when we're doing inspections. So we can't open up walls. We can't, lift up flooring, carpet. Like we can't do those things. But our inspectors have the tools that they can try to tell what might be in the walls. But there is a bit of an unknown.
And that's something to keep in mind too. Once you get into the house, there will be things that you find that we didn't know about, but the idea is that we minimize that risk as much as possible to find out as much as we can from the specialist.
Yeah. So we will, we have a list of vendors that we have, like plumbers and electricians, that we give our reports to and say, can you price out what would it cost to fix these things? Some of the vendors that, we use are a little bit on the pricier side, but we trust them and we trust those numbers. So that way we're not just giving you a lowball person that in reality, it's going to cost you twice as much. We want to be as upfront and forthcoming as possible. Again, we stay in touch with our clients after closing. The last thing I want to hear is that what we said was going to cost $10,000 was really $40,000. Like, I don't want that to happen. It's just not how we work. So once we gather all of our estimates and whatnot, then it's a negotiation again with the seller. If we can come to an agreement on, what the repairs are going to be, you feel comfortable moving forward, we can go ahead and remove that inspection contingency. If we can't come to an agreement, if there's just too many repairs, it's too overwhelming for you, or we find something that you're like, oh my God, I just cannot live here knowing that this was once a thing, we can cancel and get you that deposit back, as long as we've started this negotiation period by the end of the contingency. So we're very careful on our deadlines because we want to make sure if we do need to cancel that we can. And we have before, we have done inspections and clients have said, I want to fix her. And then we do the inspections and it just becomes too much money and we gotta walk away. Because they are your inspections, that is a cost that you will take on as a buyer. So if you do cancel, you're going to be out, the $1,000, $1,500, depending on what, the inspections that we had to do were. So just kind of something to keep in mind. During that time, you're also going to get a packet of disclosures. In the disclosures, some of them are just like city and state mandated disclosures, but then also what's in there are the seller's disclosures. And that's essentially a big questionnaire that the seller fills out, and it's everything that they know about the property. So if they've ever done any work on the property, if they filed insurance claims in the last couple of years, if there was a death on the property, that will all be in the disclosures.
Everything they know and remember.
Yeah. And remember, and that's the thing, is that they might have forgotten that they did a repair under the house 25 years ago if they've lived there for that long. So we give sellers a little bit of grace. Like I said, sometimes they don't know that things are broken because they don't use them. So sellers fill it out to the best of their abilities. What else do we do? Homeowners insurance. Okay, so if you are financing your property, this will be a condition of your loan. You have to get homeowners insurance. Or if you're buying within an HOA, you have to have insurance. As Tiffany kind of mentioned, did you mention? Maybe not yet. No, not yet. Insurance companies in California, you may have heard, are being very difficult, and a bunch of them have pulled out of California due to the fires and the storms and the floods and all of that. So what used to be a very easy check the box, not a problem process has now become a lot more involved. So as soon as we open escrow, that's something we encourage you start looking into finding your homeowner's insurance. We do have an insurance broker that can help you with that. Andy also has an insurance broker that can help. So, and those are free for you to use. So take advantage of those resources. It's one less thing, that you have to have on your plate, but it is very important. It's become so important that insurance is now its own smaller contingency within the contract. So, okay. So we've done our inspections. We've come to an agreement. We have removed our inspection contingency. At the same time, if you are getting financing, your loan will require an appraisal be done of the property. This is when the lender hires a third party to come in, and they are basically trying to justify the purchase price. Because we have reviewed recent sales in the neighborhoods, we do, for the most part, have an idea if we think a property is going to appraise at value or not. The important thing here is that if your property does not appraise at the purchase price, you are still responsible for that price. So in a fortunate situation, if there's no other offers, if appraisal comes in low, the first thing we're going to try to do is negotiate with the seller and say, hey, you know, we're under contract for $1 million. The appraisal came in at 975. Will you reduce that price? If there's no other offers and the house has been on the market for a while, they might be willing to do that. Or they'll say, no, we'll meet you in the middle. It's a negotiation. If a seller is unwilling to come down in price, then you have the option of either making up the difference by bringing in extra cash, or you can cancel. Okay. If the property appraises at value, awesome. We can go ahead and remove that contingency. On the rare occasion, your property appraises higher. Congratulations, you now have built-in equity. Your lender got a deal.
But the seller, do they have the right to say, okay,
No.
They don't, yeah, good.
So as the buyer, it is your appraisal. We do not provide it to the seller unless it's come in low and we have to renegotiate. When it comes in high, we zip our lip.
Yeah.
We don't say a
We
word.
hide that away for you.
Yeah. They don't need, because it's not public.
seller was involved?
It's not public. So we do not share with them when it comes in above, because then, you know, they missed out.
So how, well, two questions. One is, how often is the appraisal higher? And then two, do you get your 3% money deposit back if it is extremely low or if it's low?
If it comes in low and we have to cancel because of that, because the seller is not willing to negotiate, yes, you do get your deposit back. We can try to fight the appraisal or get another appraisal. It is hard to do. I think I've won a fight one time.
It has to be like factual things that the appraiser missed or.
Yeah.
Otherwise it's difficult to provide.
Yeah, and they can, if they're angry, they can come in even lower if they don't like that you're questioning them. So we don't want to do that. Yeah.
So if our houses are kind of, so why would we appraisal much lower than that?
I would say a lot of the properties that we see tend to be underpriced. And so when we're looking at comps, we're seeing that the sales are $50,000, $100,000 over what is currently listed. So if you come in at those prices, you know, an appraiser will pull 5 or 6 properties to compare. And a lot of times it's the same ones that we have pulled. Not always, but a lot of times. So we kind of know ahead of time if we think it's going to be an issue. In LA, people have money and sometimes they just don't care. And if they know it's not going to appraise, they'll just bring in the extra funds to make up the difference. There are ways of getting a little bit creative with your loan. You can change your down payment amount to kind of free up some money to then put that towards this difference. We try to figure out, is there a solution to move forward, or do we just need to cancel? When there's multiple offers on a property, if we cancel, the seller might not care because they might just go to the next offer.
But
Keep in mind.
Appraisal, like big picture, where does that live and how does that affect the value of the home? Right? Is it just, it's just a tool used in this process, but it's not like set in stone if you go to sell your house in 5 years?
Correct. It is one person's opinion of your home. So
It's for your lender because they want to make sure that the asset protecting that's the collateral for the loan is worth what you're paying for it. So it's merely a tool for your lender. Yeah, it doesn't live anywhere except in your email inbox.
Yeah.
Someone like just making sure you're not getting photo escape. That's like an old thing, so that you're not buying a house for way out of the price range. You already know you're overpaid in place, kind of already for the lower. But general cost. How often does it match?
most of the times it matches, because there are times where clients will be in love with the home and I'm like, it is $200,000 more than anything else in this neighborhood. It's not going to appraise. So there are times where we will just not even try because it's going to end up being a waste of your money because you have to pay for that appraisal. And at the same time, you still have to do your inspections. So, you know, a lot of times if it is so wildly overpriced, we will pass. We won't even write on it. We won't even, yeah.
So you're saying once you do all that homework, so when you start the process, it's usually.
If it's clear, if it's obvious, it's not going to appraise. Sometimes we don't know.
It's one person's opinion for that appraisal too, so we're kind of like at the mercy of who is going there. Do they know that market? Do they know what the dynamics are that are going on in that market right now? Supply and demand wise. So
If
I feel like
yeah.
Andy would have something to say.
Well, hang on, I wanna be
Oh, you
really,
wanna
so
do- okay.
there is, in certain occasions, if we're worried it's not going to appraise, but we believe like it's worth this price, and it's, we will put together like a package for the appraiser. So as the buyer, you don't attend the appraisal. Typically it's just the listing agent, but sometimes I will go too, and we provide the appraiser, like, these are the comps that we pulled. These are, if the house has a ton of upgrades that are not visibly obvious, we'll give them that. If there's multiple offers on the property, we tell the appraiser, there was 15 offers, because that matters. That tells them this was a popular home. The market is, busy here. We will try to do everything that we can to protect that price. If there's permits that were pulled on the property that are important, we'll give them those. Like, whatever we can do to try to support that price, we will do.
Because at the end of the day, if the appraiser doesn't think to ask, were there multiple offers on this property, there's no way that they would have known that, this is what the market is saying the property is worth, because there were so many offers.
Yeah.
What does the lender care about?
The appraiser cares about that for their report. Yeah, so they will take that into consideration if they are aware. Yeah, the lender just goes off of what the appraiser writes up, as long as there isn't a blatant error in there that sets off flags. Is there anything you want to add, Andy?
Not really. I mean, I've had some successful rebuttal appraisals when there is a discrepancy in value from the appraiser's value that they give to the property versus what the property's under contract. It requires additional comps and good explanation, and I do a full write-up and et cetera. So I've definitely had success doing that. To Rachel's point though, too, depending on what your overall qualification looks like, what your down payment looks like, maybe it is a conversation of adjusting things and massaging numbers a little bit. If it is a popular property, let's just say you go under contract and that house had 15 other offers on it, are you willing to walk away from it with a $50,000 appraisal discrepancy? I don't know. Obviously you'd have to make that decision, but we could potentially get creative in realigning numbers. And again, remember these would also be short term, right? Eventually you'd refinance when the property value goes up, et cetera, and rates come down. So, yeah, appraisal, to Tiffany's point, it's the appraiser's opinion of value, and they're pulling data based on public data of existing sales. There's certain parameters that have to be met for the appraiser to include something in an appraisal. But, at the end of the day, nobody's perfect, and appraisers also make mistakes. I've had appraisals turned over for typos. So, things happen. It's not a scary thing though. And that's what the appraisal contingency is in there for. So.
Thanks, Andy.
Okay, so let's say your appraisal came in either at value or above, we can go ahead and remove that contingency. The last big contingency is your loan contingency. So during this whole time, your lender is going to be asking you for a lot of documents. It's really important that you give them to the lender as quickly as possible. I also want to just backtrack for a second. When you get pre-approved, that is the time to be shopping lenders. Once you've opened escrow, that is not the time to shop lenders, because we will base your offer on the ability of your lender and how quickly they can move. So for example, Andy can do things very quickly, which is very helpful for the buyer, because while these are your protections, these are the hurdles that the seller has to overcome, and the sellers are nervous. So if we can kind of shorten up those timeframes and move faster, you look more appealing, because it's less time for you to cancel. So let's say, Andy in our contract, she can get a loan approved, I don't know, in like 7 days. I always buffer it and say, like, let's do 10 days. versus a big bank might need 14 days or 17 days. This all matters, you know, in the offer process. So if we,
Protecting your deposit.
if we've set, yeah, so if we've set a 10-day loan contingency, and then on day 4, you decide to go shopping and you choose a new lender and they need 17 days to do your loan, we don't have time. We can't change. You can't change those days. So it's really important that, you know, and also something that Andy will do, like when we submit an offer, Andy then will follow up with the agent and let them know, you know, she goes to bat for you and said, they're great, they're well qualified, you know, whatever she can legally divulge, she will, to kind of, you know, strengthen your offer. So then if we're changing lenders, we look shady to the sellers. So we don't want to do that. Yes.
What would be the things that make it difficult to get a loan approved?
Andy's gonna be going through more
Yeah.
lender stuff in a little bit, so maybe that'll be a better question for
Yeah,
you.
we'll ask Andy.
Yeah,
What bank does Andy work with? It's not like big.
Movement Mortgage. Yeah, they're a direct lender.
So we like the direct lenders because they are a little more flexible. They're not just checking off big, you know, boxes like the big banks do. We also get, you know, more personalized customer service. Andy is available nights, weekends, which you don't always get that with a banker that works the 9 to 5. And there are times that, you know, we're trying to figure out a counter offer on a Sunday night and we need to run numbers to say, how high can we go? What does that monthly payment look like? You know, and she can kind of churn those numbers out for us. So it's very helpful to have someone, you know, like Andy that I can just quickly text and say, hey, you know, if we're at a property or whatnot. So during the loan contingency, they're going to be, you know, doing a credit check. They will ask you for all these documents, and then those documents get submitted to the underwriter. And the underwriter is the one that is going to ask a lot of questions, and they're the ones that are officially going to like sign off essentially on your ability to get the loan. Once you have submitted all your stuff and the underwriter says, you guys are great, we can go ahead, you know, and they give us essentially loan approval. We can go ahead and remove that contingency. This takes us to closing. So at this point, we have removed all of our contingencies. You cannot cancel at this point without risking losing the 3% earnest money deposit. There are some loopholes with that, which we don't have to get into. But for the most part, once your contingencies are removed, we really cannot cancel. And we will tell you, like, this is it.
How long is this whole process? Those 3 contingencies, like where are we?
If we're being aggressive, it's in the first 10 days.
Oh, wow.
Yeah, so a lot happens very quickly.
Could be like 14 days, just depending on what the situation is.
Yeah.
You know, if we don't have to be fast.
Yeah.
Sure, contingency, we want you to have as much time as possible.
It really just depends on how, you know, if there's multiple offers and kind of what the situation, what the seller's situation is. Yeah. Okay, so once we're moving towards our closing costs, let's see, within 5 days of closing, you're entitled to do a final walkthrough of the property. So it's one more time to kind of see the property. Typically, if the property is staged or if someone is living there, we wait until they are out, if we can, so that you can see it empty and make sure, you know, everything still looks good. If there were any repairs that the seller did agree to that we had them do, we will check those. There are some city mandated repairs that the seller does take care of. We'll check that those have been done. And it's basically, you know, kind of one last chance. Also within that time frame, you are going to wire in your remaining down payment and your closing costs. So closing costs, like we kind of touched on, are typically 1 to 2% of the purchase price. So we always tell our clients budget for 2%, knowing that that's going to be on the high end. However, once we open escrow, we will ask escrow to give us like an estimated closing statement that kind of breaks down what those fees will look like. However, it's still just an estimate because some of those numbers change as time goes on.
Some of it's dependent on when the date that you actually close, and it's certain costs are prorated from there.
Yeah.
So a lot of it can be dependent on that. So that's why it's an estimate.
So the closing cost is not the buy, it's a realtor cost.
The realtor's cost is one of the closing costs.
So all
Yeah,
of it together.
no. It does not include the buyer's agent commission.
So 1% is set.
Correct. So
Correct.
1 to 2%, it includes like any like lender fees for you to get the loan, your escrow fees, your title fees, any prorated property taxes and insurance.
It could also include, depending on when you close, your first month of your mortgage payment. That's a calendar thing. So again, it's still just kind of an estimate. But so you will wire in those funds, and then you're gonna sign your loan docs and all your closing docs. This is a huge stack of documents that takes about an hour-ish to sign. It has to be done in person. So you can either go to the escrow office or they can send a notary to your home. Before or after work, they can work with that. And then once you've done that, your part is done. Typically the day after your funds arrive to escrow is when the lender will essentially fund your loan. There's nothing for you to do. But then that sets up for your deed to be recorded with the city the following day. So nothing actually happens following business day. Nothing actually happens on closing day we're not like signing documents and then you have the just sold line like you sometimes see. We basically are waiting for escrow to tell us, hey, your deed's been recorded with the city, you're good to go. Once
The official owner.
Yeah, you are now the owner of the properties. So once that happens, then we will plan to meet up that day. I will give you your keys and you just buy your first, or you just bought a property.
Any
Easy,
questions?
easy peasy.
And just like that, you're done.
How many days?
On average, typically somewhere between 17 and 30 days.
The whole escrow
The
process.
whole escrow
when
process.
Your offer is accepted to close.
Yeah. So it's depending on how aggressive we need to be. Sometimes sellers have weird things going on that they need an extra 45 days or whatnot. And as the buyer, if the seller needs that, we say, okay, as long as that works for you. So it really is dependent on the property and on the scenario, but I would say on average, 21 days is how quickly we typically move.
What about, are there any like tax or loan or different financial benefits available for first-time home buyers? Or how does that?
Yeah, Andy can talk about that. Did you hear? A first time,
If first-time home buyer programs.
No, I think tax incentives.
and tax.
Anything that can help.
Anything that can help, Andy.
No, there aren't any tax incentives. So back, 2008, 2009, there were tax incentives for first-time home buyers, and that was really to pump up the economy, right? That was during the economic recession, the Great Recession, right? There are not additional tax incentives as a first-time home buyer. There are first-time home buyer programs that are allocated and designated just for first-time home buyers. But that's really it.
We can give you a link to resources. It is very much like income based though. So there are parameters and you can see if anything applies to you.
Well, and there's going to be parameters to every loan, and just to put it in perspective, there are hundreds of loan programs out there, hundreds, and everyone has different qualification parameters. Down payment assistance programs is a first-time home buyer program. There are very strict requirements for a down payment assistance program for first-time home buyers. The other piece too is that when we're talking about these niche down payment assistance programs and so forth, it gets tough in a competitive market. So from an offer perspective, and I don't want to go down a rabbit hole of specific loan programs, but no tax incentives for first-time home buyers. That could come back. You never know. They could decide to pump things up a little bit. Nothing's off the table, but at this point, there aren't additional tax incentives.
Any other questions on that? Because that was a lot.
Yeah. It's always the biggest lift.
Yeah.
All right.
Okay.
Go ahead, Andy. Take it away.
All right. So documents you need to get pre-approved. This is very basic. And this doesn't necessarily apply to everybody. The long and the short of it is, and going back to the point about, hundreds of different loan programs, everyone is going to be different and not everyone qualifies for the same loan. When we're talking about loans and we're talking about underwriting and we're talking about getting somebody pre-approved, we're looking to see somebody's ability to repay the loan. And the way that we do that is looking at credit. In most cases, we're looking at income documentation unless we're looking at some other creative loan scenario. We're looking at income documentation and credit history to show what your history of making payments is. And then also the source of the down payment. Do you have the funds, or are you getting gift funds from a family member? Are you cashing out your 401k? Are you selling stocks, et cetera? So we're looking at all of those things to make sure and verify that you can make the payment on the new property. And that's how I get you pre-approved. I'm taking all of your documentation. Let's just say you're a salaried employee. I'm going to ask you for W-2s for the last 2 years, pay stubs. I'll ask you for bank statements to show the source of the down payment and the closing costs, unless it's a gift. And then also look at credit. Credit's a big factor when it comes to A, interest rate, and then B, credit also determines and dictates what loan programs you would qualify for. The lower the credit score, the more limitations you're going to have on available loan programs, and the higher the interest rate it's going to be. With a lower credit score, you're considered a higher risk. Usually somebody with a lower credit score is going to have, it could be a past history of delinquent payments, but that's what we have to go on is your credit. We look at your credit history to see what your historical payment record looks like. The better you are in credit score, the more doors it opens for potential loan programs as well as better interest rates. So just as a general, on a whole, when I'm pre-approving somebody, I'm going to ask for income documentations. If you're self-employed, I need tax returns. A lot of self-employed folks don't W-2 themselves. So I'm going to look at tax returns, and I'll analyze and plug in your business tax returns as well as your personal tax returns and determine what your net income is from your business. Ultimately, it comes down to what you can afford on the payment. In addition to all your other debt, if you have car payments and credit cards, et cetera, student loans, we need to factor that all in. And that's how I determine and figure out what you're pre-approved for. I will say that my process is a little bit different, I would say, than most, because I am doing basically a pre-underwrite and have the ability to also do an upfront underwrite. So if you have a little bit of a quirky scenario, I can plug everything in and go, okay, yes, here's what the option is. I'm going to also go one step further and send it through to underwriting so that we have full underwriting approval before you even start looking at properties. That A, it makes you more competitive, and B, it takes out any sort of guesswork if you have a tricky situation. So that's really it. And then at the once you're under contract and so forth, we're just verifying that you're still employed and maybe getting updated pay stubs, and that's really it. It should be it should be painless. If it's painful, then I question that.
Okay, I have a question.
Yeah, we have a question for you, Andy.
I don't know if this is a silly question, but so let's say you've had a stable job for 3 years, but then there's a period of time where you're laid off or you're not working, you're unemployed. Does that hurt your chances of getting pre-approved? Is that not a good time to start looking? How does that affect your chances of being approved for a home? Like, do you need to have 3 consecutive years of like working like full time or having good income to be approved?
Did you hear that, Andy?
I did. So, you would need to be currently employed. Let's just say you had a gap in employment for 6 months or 8 months or whatever it is, but you're currently employed. This will also be, the loan program will also determine this, but the short answer is yes, that would be okay. As long as you're currently employed, I would ask you for an offer letter. potentially a paycheck unless you haven't started the job. And then underwriting is going to ask for an explanation on what happened. Why did you have the gap in employment? So in most cases, it's okay, depending on the loan program.
Thanks, Andy.
Yeah.
I think it's also worth noting, if you're even thinking about, the buying process, but you're not sure, talk to Andy and she can look at your numbers. Many times she's worked with our clients that, okay, they were self-employed and they wrote off everything. So they showed very little income on their taxes. So then what Andy's able to do is say, okay, next year when you're doing your taxes, this is what you need to do. And she can kind of help set you up so that maybe it's not now, but in a year from now, you will be ready. And same with like low credit and whatnot. She can kind of guide you to get you where you need to be.
Yeah. Once you're even thinking about it, talk to her, because there are things that you may not know are on your credit report. If you're not monitoring it closely, we've had clients who have surprise delinquencies or whatever it may be, or a spectrum box that was never returned. That was a problem once, like this happens, and it's a delinquency and their credit score plummeted from that. And they're very qualified people. Just one thing affected their ability to buy. So it's good to just, get the conversation started sooner rather than later. And use Credit Karma. Keep an eye on your credit score.
Yeah, so is it the right time to buy? It's a big question you have to ask yourself. If you're trying to decide if you're ready to buy a home, there's probably a lot on your mind, obviously, from all the things that we just went over, and you're thinking about your finances, today's mortgage rates and home prices, the limited supply of homes for sale, and more. And you're juggling how all of these things will impact the choice you make. And while the housing market conditions are definitely a factor in your decision, your own life and your finances may be even more important. And there's an article from NerdWallet that says the housing market trends give important context. But whether this is a good time to buy a house also depends on your financial situation, your life goals, and your readiness to become a homeowner. So, number one question, do you have a stable job? One thing to consider is how stable you feel your employment is. Buying a home is clearly a big purchase, and you're going to sign a home loan stating that you're going to pay that loan back. And that can feel like a big obligation. So knowing you have a reliable job and income coming in can help you put your mind at ease. As NerdWallet explains, a mortgage is a big commitment. Wait until your employment is stable before thinking about buying a house.
Make sure you're not about to quit your job. That will affect your ability to qualify too.
Number two is, have you figured out what you can afford? To make sure you have a good idea of what you'll need to save and what you can expect to spend on your monthly payment, talk to a trusted lender. They'll be able to tell you about the pre-approval process and what you can borrow, current mortgage rates and approximate monthly payments, closing costs to anticipate, what % of the purchase price of the home you'll need for a down payment, and more. Number three, how long do you plan to live there? Another important thing to think about is how long you plan to stay put. It takes time to build equity in your home through paying down your loan and home price appreciation. So if you plan to move too soon, you may not recoup your investment. So for example, if you're looking to sell and move again in a year, it might not make sense to buy right now. A recent article from CNET says buying a home is a good idea if you're planning to stay put for at least 3 years. Home values typically increase between 2% and 5% annually. So you could end up paying more in closing costs than you would earn in proceeds if you sell after only a year or two.
So remember, there are costs to purchasing a property. So we just want to take that into consideration too.
So the benefits of buying or of owning a home, if you're trying to decide if buying a home is worth it, you want to consider the long-term benefits. So home ownership is more than just having a place to live. It's also a key way to build wealth. As you pay off your mortgage loan, your equity in the home grows, and any increase in the home's value also adds to your net worth.
Oh, this is not you? Okay. All good.
I know, here's where we are.
Okay, so we just wanted to give you an idea of how home price appreciation can help you grow wealth over time. So this is an illustration of the US, and what the average appreciation has been in each state between Q1 of 1991 to Q1 of 2024. So you'll see here in California that the appreciation over that period of time is 324%. Oh, and the national average is 315.7%. All right, and home ownership remains an important driver of wealth accumulation and the largest source of total wealth among most households. You know, I think you probably hear this a lot that, you know, people build their wealth through real estate. Like my family is very big on real estate, which is why I got into it. And it's a great vehicle to save for unexpected circumstances. For example, my sisters and I decided to invest in 2 triplexes so that we could have like a little buffer just in case something happened. Maybe we have kids who need somewhere to live. Hopefully they don't need to live in one of our properties, but it is a way to have a security blanket. And maybe that will be the way that we fund our kids' education if we need to, like down the line. So it's a good holding place for your funds to just keep appreciating value so that if and when you need it, you can liquidate it and have this bucket of funds to use. Home equity is one reason owning your own place can really pay off in the long run when you're ready to talk with a local real estate professional. All right, writing the winning offer. I think you're up, Rachel. Okay.
All right. So how do we get you into a property? It's not just about the purchase price. That's a big part of it, but that is not the whole thing. So number one, making a good first impression. So this goes back to when we're at open houses or private showings and the listing agent is there. You know, there used to be this old adage that you have to have a poker face and you don't want to show excitement. That does not fly in this town. If you see a property and you like it, the agents want to know that because they are then going to relay that to the seller. Oh, they came multiple times. They were so friendly. They loved it. You know, most sellers want their homes to go to, you know, good people.
And I can also speak to, you know, when we do have multiple offers and we're presenting them to the seller, you know, whether or not there are multiple offers, it honestly doesn't matter. It's important for me to relay to the seller what this experience is going to be like. What are the pros and cons? What are the possible challenges with this buyer if there are any? So beyond just the terms of each buyer's offer, you know, I'm relaying, oh, you know, they seem very excited about the property. And the reason why that is helpful to you is it creates a bit of stickiness from the buyer's standpoint of if there are challenges, they may be more likely to stick through the process and talk through all of that versus being a flight risk, right? Because at the end of the day, a high price is great, but if they seem very nervous and likely that they may not get to the finish line, seller's not going to get that money. So these are different factors that we do take into consideration when reviewing offers.
And there have been times that, you know, I represented a pair of buyers and they were looking in Sherman Oaks and there was an investor that was significantly higher than our offer. And we were way over the list price, but this investor was $50,000 more than us. The seller did not care. It was his home. He raised his family there. And he was like, I don't want this to go to a developer that's going to just put up some giant house, this cute little bungalow. They chose us because they loved our clients. Our clients were super sweet. They were very excited. You know, I really connected well with the listing agent. They were able to, you know, go to bat for us and we ended up winning the deal. So, you know, that's not always the case, but more often than not, it can be. We've also had where we are not the highest offer, but an agent has come back to us and say, hey, we really liked you guys. We really think, you know, you guys give a great offer. Can you come up? You know, you're 25,000 below the highest. Can you guys come up? And we've gotten that opportunity and we've closed on a couple in the last year from getting a second chance. So it does matter. Determine the seller motivations and their needs. So, you know, every seller is different. Some may be looking for their next property or some have already identified where they're going to move to, but they need extra time in their home. you know, being accommodating of their needs can show them, you know, at the end of the day, they can just say no to us. So we want to show them that we can, you know, accommodate whatever it is that they need, as long as it, you know, makes sense for you guys. Assess contingency deadlines. So this is where we get into possibly waiving contingencies. I don't want to dive into this now. It's a conversation that we have to have, but it is expected in a multiple offer situation that you will waive, if not 1, 2 contingencies. And there are protections and loopholes that we know about, because we know this contract so well that we can still make sure you're protected. So we will talk about that. If we don't have to waive a contingency, that's wonderful. I don't want to do it if we don't have to, but
No one's ever gonna force you to do it.
no,
To be
and
clear.
we will go over the pros, the cons, like this is what's at risk. It's up to you to make that decision. It's how badly you want a home. You know, we have clients that are, you know, the first couple months, they don't want to waive anything, and then they're tired of looking, and it's exhausting, and they've lost out multiple homes that they've loved. It's time to get aggressive. So we will tell you, you know, what we think needs to happen, but it's up to you to decide what you want to do.
And every situation will be different.
And then just presenting a clean, well-packaged offer, that's on us. We want to make sure that the offer is filled out properly, that everything is, you know, clean. We have a very templated email that we send that breaks down your terms. There used to be a thing where buyers could write a letter to the seller. Those are really kind of going away. We still try if we can, but a lot of times we're now being told we can't submit those letters. So in our offer email, I'll put stuff about you. I'll explain kind of like who you are and your, you know, your background and why you're so wonderful and why they should choose us. There's a couple other things that we do that we're just not going to put in writing. But we do have some other tricks up our sleeve.
I think the idea is like, you know, it is an art form to present a clean and well-packaged offer. So whatever we can do to help you set you apart from the batch of offers, if it is a batch of offers, we want to do, because we are making an impression on what it would be like to work with us. You know, there are so many hands involved in each transaction that, you know, agents will advocate for an agent and their buyers who will probably be the easiest to work with. So we want to show that we know what we're doing and that we will make it as easy as possible for them. So that's why there are all these nuances to it. Okay, what to watch out for. So something that we talk about a lot with our clients is when you're purchasing a property, figure out what the exit strategy is. Because life is unpredictable. Sometimes you may need to leave the property that you thought you were going to be in for the rest of your life. You know, circumstances change. You get relocated for work, whatever it may be. So we want to make sure that we're protecting your investment as much as possible, and that if you have to sell the property unexpectedly, that we can do so easily and quickly. So there are certain things that we know to typically narrow the buyer pool. And if you have a smaller buyer pool, that typically means that it's harder to sell, and that, you know, it doesn't appreciate as well. And it also will, you know, be a little bit of a longer process to sell that, to offload that property. So the reason we go through these things is that, you know, sometimes it doesn't matter to you that you're backing up to a freeway or that you're on a busy street, but other buyers typically care. So that's something to take into consideration. Poor construction or cheap finishes on flips. It may look very pretty on the surface, but, you know, these cheap finishes wear out more quickly. So if you need to replace parts sooner rather than you should, that will cost you money, and we may need to have that redone before you put your property on the market, or strongly encourage that if you can. How well cared for the home is. There is plenty in the property that you can't see. We can't see the plumbing behind the wall. We can't see under the house unless you go crawl under there. So if a property looks like a hoarder's home, like when we're in it, that is typically an indication that they're not taking care of the property in and of itself. So we want to be careful about, you know, which properties you're deciding to move forward with, because you'll likely have more surprises with that hoarder home than others, right? amount of natural light. So this is my favorite one to talk about. So we work with a lot of buyers, and we would say that 98% of them say that natural light is one of their must-haves. And we ask for 5 must-haves when people are purchasing a property. So we know that the general population wants natural light. So you may not care about natural light, but your next buyer pool will. So my sister is prone to migraines, and when she was purchasing her first property, she told me that, you know, she doesn't care for natural light. Actually, the darker, the better, because that natural light will trigger migraines. I told her, yes, you may not care, but that will affect the value of your property moving forward if you do decide to offload this, or even if you rent it out. People want natural light. So that's something to take into consideration. Rules and regulations in HOA communities. So each HOA has their set of rules that govern the building. And if you buy into this building, you are now subject to these rules. So for example, one very common one is that, you know, they may have flooring restriction, and you'll need to know this beforehand, because they may say that all the common areas and the bedrooms need to be carpeted. The typical buyer doesn't want that restriction because most people don't like carpet. It's okay to some degree if it's not everywhere, but we want to know that in advance, because that will affect its sellability later on. Even if you're okay with carpet, which is great. I grew up with carpet. I'm typically fine with carpet. It may affect, you know, what the value of it is later on. Upcoming impacts to HOA reserves. So HOA reserves refer to this community pool of money that is used to address and pay for any large projects with the building. So for common areas. So for example, if the roof has a leak and it's going into someone's unit, the HOA typically goes into this reserve fund in order to fund that project. And with, you know, the storms that we had at the end of last year and the beginning of this year, we're seeing this become more and more of a problem with HOA communities, that they found water intrusion issues and had to dip into their reserves in order to pay for these repairs or for the roof to be re-roofed. So we've seen a big hit on HOA reserves, which matters to you from a financial standpoint, because they are probably going to raise HOA dues if they haven't already, or they're going to levy a special assessment, which is a one-time, not one time, but it's a one-time project to replenish the reserves, which can be broken up into installments. So that you'll want to know about that if you're purchasing this property. And insurability. We talked about this a little bit already, but you want to know how much it's going to cost to insure your property, because up in the hills, for example, it can cost like $10,000, $15,000. We've heard as bad as $20,000 in order to insure your property per year. You want to know this if you're going into this type of property, so that you can decide to walk away if that's not something you're comfortable with, or you can at least financially prepare for that.
When can we find out HOA reserve during the inspection period?
You can.
So I always ask, like when I'm doing my homework on the property, when I'm talking to the agent, I'll ask, do you know what's in the reserves? Do you know if there's any special assessments, anything like that? Sometimes they know, sometimes they don't. So if they don't know yet, we will get an HOA package during escrow, and it'll be in there. HOA, that is its own contingency. So if we find out that they have like no money in the bank, there's a huge assessment coming, you can back out.
So I think it's important before we close escrow or during the inspection period that we actually cancel.
Yeah, you'll find out.
Right.
You
have to know this.
You need to know.
Exactly. You will receive it during your due diligence period, and even if your inspection period. But yes, they actually have to provide it. Yeah, so it is a requirement before you close that they provide it. And if for some reason your inspection period period has already passed, but they still have not provided it, it's okay. Because once they provide any new information, you still have, that triggers a 5-day review period for you. Yeah, so you still have that protection. They can't just withhold the information the entire time.
Let me just also say too, from a loan perspective, if you're purchasing a condo or a home, it could be a townhouse that has an HOA, us as the lender, once you open escrow, we're going to request the HOA documents from the HOA manager. That's going to tell us as the lender what the financial strength is of the HOA and the solvency. If the HOA is short on reserves, we could potentially have an issue with the loan. Fannie Mae and Freddie Mac have requirements for HOAs and the amount of reserves. Is there a litigation or not? Et cetera. How many units are rented? How many are owner occupied? So from a lending perspective, we're also going to review that during the contingency process as well as a backup, if you will, to make sure that you're purchasing in a community that is in good standing, and has a good financial status. The other piece too, in terms of insurability, and they talked about this earlier about the insurance in California being a real problem these days. Insurability is one thing, the premium is another, and the high cost of homeowners insurance now in California can absolutely impact your qualifying for a loan. And whether A, you qualify, or B, maybe it requires that you have to come in with a substantial amount more for down payment in order to help offset the high insurance premiums. I had clients recently that purchased, and the premium for a single family home that wasn't even necessarily in the hills was over $10,000 a year. And that impacts, we have to include that insurance premium in your qualifying number. So really important to know that ahead of time and start working on quotes ahead of time. And also there's a cool little tool on Redfin that shows you what the fire danger looks like for a property. And if a property's in a high fire danger zone, you're going to know right off the top that the insurance premium is likely going to be pretty high. So insurability is a big one, not just from the purchasing aspect of knowing that you can get homeowners insurance, but also from a lending perspective and qualifying.
How as buyers are we supposed to even know? I mean, is that just a conversation you're having with your?
We have that conversation with our clients as soon as your offer is accepted, or even before. If
I was
we
gonna
find that
say,
information.
If it's a property, so I do check if it's in a fire zone. If it looks like, okay, this might be, it's not in the hills, it's not near the water, but it's like, oh, it is, it's a weird little pocket or for whatever reason. Sometimes I'll reach out to our insurance broker. I'm like, can you just run this? Like, and just give me an idea of what would this, what would this cost? So that we can kind of figure it out ahead of time.
And I'll give everybody a quick little trick too. If you look at a property on Redfin and you click on the map, so say you put in an address, 123 Main Street, and the property shows up and it has a little map of where the property is located. If you click on that map, it'll pull up little buttons. It'll say fire, flood, hazard, etc. There's a couple more little buttons there. If you click on that and you click on the fire button, it'll tell you whether it's in a high, medium, or low fire zone. So just a little trick there.
Thanks, Andy.
Yeah.
Your turn. Rachel.
Okay. Mistakes that buyers make. When I bought my first condo, I was not licensed. I was still in production and I made a ton of mistakes. So I have learned the hard way, some of these things. So I'm very sensitive. Overpaying. Look, if you're only going to be in a property again for a couple of years, then it may not make sense to spend $50,000 over the list price. If it's a place that you can see yourself being in for a while, then yeah, we can talk about, going higher. But sometimes buyers get very caught up in the excitement of the counter, and we got a counter and there's, 20 of us, and you just get so emotionally attached to the property that you want to go crazy. That's part of my job, is to be like, okay, that's not going to appraise, or I don't think that's going to appraise. And we kind of have that conversation. So overpaying is a big mistake. Getting blinded by pretty by pretty staging and pretty photos. There's a reason why agents stage properties, because it looks really nice and you're walking in, this is so cute, this looks so great. You gotta look past that, because all that staging is gonna go when you buy the property, or you're not buying the cute furniture. So you really have to pay attention to, okay, how does this layout make sense for me? Where is my television gonna go? Because stagers don't put TVs in properties because they're not pretty to look at. So we wanna look at the functionality of a space, and does this really make sense, for what you're looking to do? Yeah.
So my sister years ago, she bought a house in Texas, and she didn't know that the AC unit where it's located is the only place you can put a TV. So she found out during the hot summer season that you can't even hear the TV because the AC is so loud. So she said she wants to move out because of the inconvenience of where the AC was placed. So when they were house shopping, they weren't like asking the home lenders to, or like the agent, sorry, to turn on the AC, you know what I mean, to hear how loud it is.
Absolutely.
So that, I don't know, that was just something I just thought of. I'm like, that sucks.
People get very caught up in the photos.
Yeah.
On the flip side, sometimes agents don't pay for professional photography and they're just using, whatnot, or they're not staging a property. It's also important not to discount those properties. Just because the photos aren't so pretty, it could be actually a really great space. So, we try to look past all of the shiny, pretty stuff and see like, okay, does this actually make sense? Not vetting for experience representation. I think there's a myth that buyers want to just work with the listing agent because they're going to be able to get a deal. That doesn't work here. That's not, if you're working as a buyer with the listing agent, they are not protecting you. Their fiduciary duty is to the seller. So it's really important that you have your own representation, and that, you ask them questions, you vet them, see, do they have, review pages? Are they on Yelp or Google? Really kind of digging into what you can with them. Under sharing with your agent, it is so important that we know what is going on in your life. We know that, I had clients that were an offer on a property, and then he called me that night. He's like, oh yeah, by the way, I'm going to quit my job this week. And I was like, well, we can't write an offer on this property then, and we just wasted all this time. So it's really important that you share with your agent, any big life milestones. We often find out before families when people are pregnant, because that changes, what they're looking for. Or we have found out our clients are married and their families don't know. So it's really important that you talk with them. I have a buyer right now who just tried to go shopping for a loan, and we're already in escrow. So we can't change that. And I didn't know that he was doing this. So it's really important before you do anything of a sort that you're, talking to your agent. That also includes big purchases. If you need to buy a car, if you need to do something, we need to know, because all those things impact your loan. So communicate with your agent. Not being gutsy. There is an element of having to have, the guts to do things, to waive the contingencies, to be aggressive. Not always, it doesn't always happen, but more often than not, there's going to be some risk involved, but we will always tell you what that risk is and how we can minimize it. Not doing a deep dive during the investigation inspection period. Some agents will do pre-inspections on a property where they have, or sellers will do inspections. They have the inspectors come out and check out the property, and they provide those reports to us. We still want to do our own inspections. Unless they are using our go-to preferred inspectors, we want our guys to have their eyes on it as well. So it's important that we really check out the property. Even things like driving by the property at night, making sure you're comfortable with the neighborhood at night, making sure you're comfortable with the commute for work. If you're looking at a neighborhood that's further away, make sure you're okay with that drive time. So just really trying to find out as much information as we can.
A glimpse of some interaction with the neighbors can help too. Maybe next door to this person for some time. Or stories like that. Not our clients, but
No.
that's cool.
Not trying to negotiate credits. So we will get a lot of times where the property is being sold as is. That means the seller doesn't want to make any repairs to the property. This is a common tactic, especially when there's multiple offers on a property. However, that does not deter us. If we do inspections and we do find something that is very wrong or it's going to be very expensive, we will still try. We will still try to negotiate. We'll still try to get you that credit. And if we can't, then it'll be up to you to decide what you want to do. When a property is being sold as is, we will let you know that ahead of time. It is disclosed to us. It's usually they put it in the contract. So, you have an idea that like, look, the seller may not be willing to make these repairs, case by case basis. Not budgeting for surprise repairs. Things will break in the home the first week you own it. It is Murphy's Law. Like it will happen. So just making sure you don't spend all of your money on, the purchase itself. Make sure you have a buffer because things go wrong. It is inevitable. Not having an exit strategy. So like we were saying, if we need to turn around and sell this property quickly, making sure that we can. All that means. Not protecting yourself legally, insurance, tax-wise. We always recommend if you have a CPA that you talk to your CPA as you're doing these things, depending on where a down payment is coming from. Does it make more sense to, liquidate stocks versus your 401k versus whatever? You have that conversation with the people that, with your money, people that you trust. Not taking into consideration sellability. We kind of talked about that. Making large purchases mid-transaction. So like we were saying, if you spend, if you need to buy a new car, if you have to, do something, this will impact your credit. This will impact your ability for the loan. We don't want to do that. So if something comes up that is unavoidable, you need to talk to the lender right away so that they're aware like, hey, this is happening. Life happens. We get it. We just want to make sure that you don't do anything without talking to your lender first. That's it.
Thank you all for your attentiveness, your great questions. We're grateful that you spent the first half of your Saturday with us this morning. Do you have any questions for Andy too?
Yeah. About us, about the process, about Andy? No.
Okay.
Okay.
All right. Easy enough then. All right, ready to wrap up? Oh, please feel free to grab more refreshments too.
And we'll be around if you guys want to ask us something, personally.
And we'll also provide the recording of this workshop as a follow-up so that you can, re-listen to anything that you may have missed. We'll have Andy copied on the email too so that you can connect with her if you have more personal questions that you want to run by her.
I'm always happy to be a resource. Thank you so much, everybody, for having me, and I'm happy to help.
Thanks, Andy.
Thanks, Andy.
Appreciate you.
Appreciate you too.